Hello and welcome to the Tax Roundup for August. Inside this month, we're going to look at what you need to be doing to access that Division 7A relief. We'll also take a look at the Home Office expense issue and particularly for those COVID-related measures where some of the issues are actually occurring. But first up, of course, the big news is JobKeeper 2.0. Michael Carruthers is going to take you through the detail and some of the issues. Across to you, Mike.
The big news this month is the government's announcement that the JobKeeper scheme will be extended beyond the original ending date, which was towards the end of September this year. Basically what the government has announced that we'll basically have another 13 fortnights of JobKeeper, albeit with some new eligibility criteria and some reduced payment rates as well. Now, at this stage, it's important to note that this is just a government announcement. We don't have the updated legislation on this as yet, so there are still some question marks on certain key issues. But we have the government's announcement, we have some Treasury documents which presumably give us a reasonable picture of how JobKeeper 2.0 will end up looking, but we are still waiting on the final details. Now, the way JobKeeper works at the moment is a number of eligibility criteria that need to be satisfied, including a turnover reduction test. And that just needs to be passed once. Once you have passed it for a relevant month or quarter, you basically can access JobKeeper right up until towards the end of September without having to pass that test again, as long as you meet some other ongoing requirements. Now, the government is suggesting that to get into the expanded version of JobKeeper, you will need to basically satisfy some additional turnover reduction tests. And the way that's going to be done is the new version of JobKeeper will basically operate in two different phases. There'll be a phase that runs from late September through to early January, so 7 fortnights that are covered there. And to get into that phase, you will need to, by the looks of it, already need to qualify for JobKeeper version 1. You will also need to pass a turnover reduction test for the June 2020 quarter and also the September 2020 quarter. So you'll need to pass a test for both of those additional quarters, in addition to whatever test you passed to get into JobKeeper at the moment. So that will get you into JobKeeper for another 7 fortnights. Then to get into the last phase of JobKeeper, at this stage anyway, which would go from early January through to late March, so another 6 JobKeeper fortnights, you then need to retest again. Not only would you need to have passed that turnover reduction test for the June quarter and the September quarter, you will then also need to add on the December quarter. So in addition to probably having to pass an existing JobKeeper turnover reduction test, you then have these 3 additional testing points that need to be satisfied. And it doesn't look like at this stage anyway that can be done on a cumulative basis. So if a business has improved through the June quarter and hasn't suffered the required decline in turnover for the June quarter, the fact that things go very bad for you in September and December, at this stage doesn't look like it will be enough to keep you in JobKeeper for the expanded version. But as I said, this is just an announcement. We'll have to wait for the final rules. Now, there's just a few other key points to note based on what's been announced to date. In some respects, the rules pretty much stay the same. So in terms of the turnover thresholds, the reduction thresholds, we're still looking at 50% or 30% or 15% depending on the type and the size of the entities involved. Basically, the same threshold that applied previously will probably apply moving forward, but will just need to be tested at least once or twice more. For employees, no new rules in terms of being an eligible employee or an eligible business participant, but one of the key things around JobKeeper version 2 is that the payment rates will be reducing. Not only will they be reducing, they'll also be structured in 2 tiers. So you have a higher tier payment rate and a lower tier payment rate. Whether someone falls within the higher tier or the lower tier will depend primarily on the average hours they worked across the month of February 2020. So it seems like that is going to be the crucial period for determining payment rates moving into the new version of JobKeeper. And it's a 20-hour threshold that is currently being proposed for that. If someone worked on average 20 hours a week for basically the 4 weeks leading up till the end of February, then they get pushed into the higher rate. Someone who worked less than 20 hours per week on average across that period falls under the lower rate. Now again, we're yet to see full details of exactly how that might work. There'll be lots of people who have maybe unusual circumstances through that month. They might have taken some leave, they might have been helping fight the bushfires. There's all sorts of things that might have occurred through that month, which could skew things a little bit. We're told that the ATO will have some discretion around that and be able to basically implement some alternative tests for determining that. The other thing that comes to mind straight away is that 20-hour threshold is also going to be used for determining the payment rate for eligible business participants, the sole traders, partners, adult beneficiaries of a trust, and directors and shareholders of a company. How are we meant to determine the hours that someone worked in the business if they weren't on the payroll, not necessarily doing timesheets and the like, don't have formal employment contracts? What evidence would you need to be able to determine that? Well, at the moment, we have no idea. That is one of the gaps in the information that's available at the moment, but we'll probably just have to wait and see if the ATO does offer some practical guidance or whether the government offers some practical guidance on what we will need to do to evidence the hours that someone might have worked. So there are some new features to JobKeeper version 2 in terms of additional eligibility tests. For employees, the payment rates will drop and we'll have to look at that hours worked across February to determine payment rates. But leaving that aside, presumably we'll be looking at some fairly similar concepts. The final thing just to note is when we're looking at those turnover reduction tests, what the Treasury documents are saying at the moment is that we're going to be looking at actual GST turnover for the relevant quarters, so the June, September, and possibly the December quarters. Well, actual GST turnover is not a real thing. That's not a defined term in the GST system. Treasury is suggesting that what they're getting at is the numbers you would actually disclose on your activity statement. But that again raises some issues. Many entities are not registered for GST, so they don't report their sales on an activity statement. Again, we're told that something will be put in place for those entities to determine how they approach that test. The other thing that was a major problem when it came to the first version of JobKeeper was calculating GST turnover. What method did you use? And finally, the ATO published some pretty comprehensive guidance on the options that would be used or could be used to calculate GST turnover. It remains to be seen whether there will be some flexibility around that. Do you use your activity statement figures as a default, but maybe have some flexibility if that's not appropriate? Or is there just no flexibility? Maybe if you're registered for GST, it's just the numbers that are on the activity statement are the numbers you use. We don't know the answer to that at this stage, and that is a pretty major kind of gap at the moment in the information, and we will need that information to be able to kind of work out whether clients are likely to qualify or not. Now, while we don't have the rules and there's still a bit of time to go before the new version kicks in, there are certainly some things you can start doing now. You can start looking at the June quarter figures for your clients to determine likelihood, kind of more likely or less likely to be able to satisfy that reduction over the June quarter. You can start having a look at employees and what hours they might have worked across February as well, just in terms of putting them into that high or low payment rate category. So there's things that we can start looking at now ahead of time. The advantage this time around is we do have a bit of time to get our heads around how this might work before we hit the date where we need to start making some firm decisions. But we are still waiting on some information. Just keep that in mind as you're having those conversations with clients.
Now on to Division 7A relief.
We're going to turn to Division 7A for a little while, and there's a couple of key things to note around developments in that area. The first one is that a lot of us have been trying to keep up with what's happening with the proposed changes to Division 7A. And there's been a bit of uncertainty for quite a while, and really the government kind of wasn't too vocal on this issue until quite recently. Now, while the start date for the proposed changes to Division 7A has come and gone a few times, the most recent of those being 1 July 2020, which has kind of just passed. What the government has now told us is that the timing around those Division 7A changes will operate a little bit differently. Basically what will happen is that once the new legislation is actually passed, those rules will then kick in from the next financial year. So rather than there being a risk of retrospective changes and having to kind of look back at what might have already occurred, it does seem like we'll have at least some time, it may not be a great deal of time, to actually understand the rules before they actually become effective. But at this stage, we don't have a really clear idea of when we might see, for example, some draft legislation or indeed actual legislation introduced to Parliament on Division 7A. So wait and see, but at this stage, it looks like those changes are maybe just a little bit off. The next thing just to cover is the ATO has come out with an administrative position around 2020 year loan repayments for Division 7A complying loans. Now, as many of you would be aware, when you have a private company lending money to a shareholder or other related parties, there's a couple of different ways we can deal with that to avoid a Division 7A deemed dividend. One of those is to have the parties enter into a complying Division 7A loan agreement. And if that's done on time and that loan agreement meets the relevant conditions, it stops the loan balance from being treated as a deemed dividend, but it moves you into this new space where you then need to ensure that the person who borrowed the money or the entity that borrowed the money is making minimum annual repayments to avoid the shortfall in any repayments being treated as a deemed dividend. Now, for many people, the 2020 income year was a bit of an odd year, and for some people, they may have found it very difficult to make those minimum repayments. Things changed for some people very significantly, particularly through the second half of that financial year. Now, the way the rules work is that if you haven't made your minimum repayments by 30 June, then the shortfall becomes a deemed dividend subject to the company's distributable surplus. But the rules have some flexibility built into them where you can basically approach the Commissioner and seek discretion for basically relief from the harsh implications that might otherwise be triggered. Leading up to 30 June, a number of people were calling on the ATO to make some sort of public announcement about that. What should people be doing if they were finding it difficult to make those minimum repayments? Well, the ATO has now come out with something. Basically what the ATO has said is that if you have clients who could not make the minimum repayments by 30 June because of effectively circumstances that were beyond their control, there is now a way of applying to the Commissioner in a quite specific way, setting out the circumstances and hoping that the Commissioner will agree basically to disregard the deemed dividend that would otherwise be triggered. And what the ATO is suggesting in those cases where people meet the relevant conditions, that repayment obligation kind of just gets pushed into the 2021 year. So by 30 June 2021, those people would need to ensure that they've made their minimum repayment for both the 2020 year and the 2021 year. So basically giving a 12-month extension on making the 2020 year repayment. But they would also need to make the 2021 year repayment in that year as well. So that is not compulsory, you don't have to do that, but the option is there. The ATO has a specific method for seeking that discretion, I guess, but you do need to have some information and some evidence to show that you've met the relevant conditions. So some potential relief for some clients who have had a nasty impact to their circumstances this year. So be aware of that. We need to identify those clients who might be affected and then just work through that formal process of doing what we need to do with the ATO to get that relief.
Now on to home office expenses and what's going to be a nightmare for most accountants, telling clients what they can and can't claim as an expense.
Many of us would be aware that the ATO has released some guidance and some concessional approaches for people who have basically been forced to work from home through much of the first half of the 2020 calendar year. So in addition to being able to claim deduction for actual costs for home offices where the relevant conditions are met, or the existing safe harbour or shortcut method of 52 cents an hour that the ATO has provided for a while now, the ATO has given this additional shortcut method to employees who are working from home through the 2020 year. Now that additional shortcut method, which is 80 cents per hour, which is meant to basically cover everything, that was due to end, that administrative concession was due to end at 30 June. Well, the ATO has basically extended that deadline. So at this stage, the ATO is saying that approach can continue into the 2021 year up until the end of September this year. But the ATO has flagged that could well be extended again. It really just depends on how things pan out over the next few months. So just important to be aware that 80 cents per hour shortcut method It can potentially be used for some clients in their 2020 tax returns, but it may also be relevant for the 2021 returns as well. The key thing there would be you need to have some record of the days you were actually working from home and the hours that you were working there. The ATO is taking a pretty lenient approach in terms of normally you need a separate area of the home set aside just for work. Well, the ATO is not being as strict around that at the moment, but there is an expectation that you have some evidence of the days you are actually working there. Beyond that, you don't really need evidence of actual expenses, etc. It kind of is assumed that that rate will capture everything that you might have incurred around your home office. So just important to be aware that that has been extended, and it may well get extended again. We'll just have to wait and see. The other thing just to note in that area is that the ATO has over the last few months been publishing frequently asked questions and answers on situations that might be a little bit different now because of what's happened with COVID-19. One of the comments that the ATO has made is that someone who is basically forced to work from home can't necessarily then claim occupancy costs for their home or their home office. Now, it is generally more difficult to claim occupancy costs, so your mortgage interest payments, rental payments on a home office, and you normally need to show that that is a place of business or that basically you have no other workplace available to you and you must work from that place. The ATO is basically saying that despite the fact that because of health advice, you may essentially be required to work from home for a period of time, that's not enough to make your home a place of business. While you can then potentially claim running costs, and as we've talked about, there's a couple of different ways we can do that, it doesn't put you into that category of claiming occupancy costs. That's the ATO's view around that anyway. So just be a little bit mindful of that, again, especially when you're preparing 2020 returns for clients and having those conversations over what can and can't be claimed. Occupancy costs, really hard still to claim those, even when people maybe are effectively forced to work from home for a period of time.
And that's the tax roundup for this month. For Knowledge Shop members, you can access the full year-end standards on the member website now. So that's your year-end checklists and also the self-managed super fund audit program. For those of you who aren't members of Knowledge Shop as yet, then give Claire a call on 1800 800 232 and she'll be happy to show you exactly how we're helping accountants across Australia. We look forward to speaking to you next month. See you then.